First, it's on your screen, Tuesday morning, and it's a good start. The breadth is, I think, the most powerful one. Nifty is off to a good start. We're adding more weight. Sensex is adding more weight. Small cap index, mid cap indices, all of them are moving in tandem with each other. So it's a good start. Lot of green on the screen once again. Let's straight away start addressing some newsmakers. Important newsmakers are, it has to be LTI Mindtree, Tata Elxsi. I will not be surprised if the downside in Tata Elxsi gets opened more. LT Mindtree is an expensive stock. Numbers have been not a washout but disappointing. And then Sheela Foam, which we marked for you in the pre-open session. In terms of a momentum name, I would say PSU banks, Can Bank, BOB, State Bank of India, Union Bank. That's one space where the price action, I think, is going to be very, very obvious in terms of momentum. Can Bank 334, SBI 603, and then you got Bank of Baroda, which is at 202. Autos, I mean, that's the real, in a sense, the engine sector, so to speak. And autos are off to a flat start. Are they getting expensive? That's a question you would ask yourself now, considering up on an average is about 35 to 40% across the board in auto stocks.
A couple of other names which are in focus, and I want to check in on what Infosys is up to, considering they're in an agreement worth about $2 billion with one of their existing clients to provide AI services, which is why you're seeing this kind of a move on Infi, 2% higher on Infi, 1450 is where the stock is, and remember, it's due to declare its numbers yet. HDFC Bank, and yesterday after the numbers, you had the conference call as well, which happened post-market hours. The management is saying that domestic retail advances have grown 20%, led by home loans, 1% higher for HDFC Bank. It's almost on its way to 1,700 rupees per share. Federal Bank Financial Services, or FedFina, the board has now revived the IPO plans via fresh issue and OFS. That stock has started off mildly in the green, but this is incrementally positive. However, I want to see what Z is up to after that very emotional penning of almost an exit letter from Puneet Goenka to their employees, saying that promoter level problems should never be the problem of the company. Z has started off 1% higher as we speak. 231 is where that stock is. Then, of course, there's Sheela Foams, like Nikunj highlighted. It seems like there is going to be a block deal on Amara Raja as well. That is what some of the media reports seem to be indicating. Tata Elxsi, weak numbers coming in there. LTI Mindtree as well, a muted first quarter. Sheela Foam, that gap up of double digits, that sort of eased off. Tata Elxsi is down 3%, and LTI Mindtree as well is down about 3% is where it's headed for. So there's RVNL as well. The government has asked to resolve differences with Russia's TMH with regards to the railway tenders, as well as other issues. That is what the Economic Times is reporting this morning. So look out for that stock as well in trade. But yeah, that's pretty much it. The trading sentiment right now. We've started off once again. So now just 10 points away from 19,800.
Yeah, every day 100 points of psychological breakout.
Is the speed of the rally, is it kind of unnerving?
But it is not euphoric. So that's the point. So, whether you look at it from an intra-country perspective or whether you look at it from the globe, Dow Jones is nowhere close to its previous highs. The Russell Index, which is nowhere closer to a major breakout. So when you look at all those components, we feel that the global bull market has not yet gone to that euphoric phase, and which is why I think there could be more stages on the upside. In terms of the opening stock, which I would look to trade, and again reinstating the bullish stance on PSU banking names, Canara Bank is something which looks attractive. I think the stock has recovered from 320 levels to 330, 335 where it closed yesterday. So looks attractive for a short-term bet, and that's the stock which I'll look to trade in the open.
Right. Naresh, what about the first trades that you're punching in?
So that would be Avanne. SBI, the stock has broken out above the 600 mark, keeping a strict stop loss at 590, expecting a move towards 620 and 650.
SBI and Can Bank, could it be a day for banks? Well, between IT and banks, go for banks, banks, banks and banks. I mean, there is just no way you should even think about it. Banks, every decline is a buying opportunity. IT, you may get your sporadic rallies. You may use the word dead cat bounce. You may use the word, deep swell. But IT, I think, is not out of the woods. Selectively, they're niche IT companies. They will always do well because IT is not just coding and software and body shopping and cloud implementation. There are companies which are doing SaaS. There are companies which are doing, company like MapMy India, RateGain. These are very differentiated companies which have a B2C angle in it. But in general, for the broader picture per se, which is IT and IT enabled and cloud enablers, I think the bottom may be made, but there is still a lot of fog on the windscreen, so to speak. So the car will be moving, but imagine if the car has a lot of fog on the windscreen, you will have to slow down. For banks, I guess they are in fifth gear and there are no red lights, at least in the near term. So what will happen? You will gear up and you will speed up. And that is what is happening in banks. There you see the bank Nifty. So Kunal, why not SBI? I mean, if the logic of banks is that they will make a comeback, then one should really say, I'm going to buy a leader who's underperformed.
Yeah, so I think SBI is also a stock which can be bullish, but I look out for stocks which generally tend to give slight higher alpha in terms of returns, and when the risk is also a bit more on a moderate basis as compared to the large cap heavyweights of the sectors. So I believe in that regards, maybe a Canara Bank, Bank of Baroda, relatively PNB, these stocks can actually stand to outperform and lead up the second phase of the rally. So yes, SBI also looks attractive, but then I believe that the higher returns or higher alpha could probably be generated in the tier 2 names.
Okay, let's also hear it out from Saurabh Mukherjee from Marcellus Investment. He continues to remain bullish on IT stocks, says the likes of TCS will continue to offer value to investors.
So first let's look at the numbers, whether it's TCS, whether it's Accenture. Their order books are growing at a rapid rate, right? I think TCS in total 17 or 18%, $10 billion swelling of the order book, which I think translates into 17-18% growth in order book, right? So order book growth hasn't weakened. Now, why hasn't order book growth weakened? Firstly, because AI is not a negative for IT services company. I just find it astounding as to where this notion arises that AI is less work. AI means more work for IT services companies. AI also means that the testing element in a bespoke software project potentially can be done with lesser labor. But that's a saving for TCS. It's not a reduced amount of workload for TCS or indeed for Infosys. So I don't understand this point of view why AI is a negative. To my mind, AI is an even bigger positive. Secondly, what we are hearing from our friends in America, from the CTOs who give work to firms like TCS, AI increases the need for Fortune 500 companies to go to the cloud. Remember, only 30% of Fortune 500 companies are on the cloud. AI makes it imperative for them to move to the cloud quicker, which means more cloud migration work for the Indian IT services firms. And the third aspect, the near-term piece, if you're going into software economic growth, you're a Western company going into software economic growth, I presume you have to cut your costs further. One of the most straightforward ways to cut your costs further is move more work to India, automate further. To automate further, you need to hire firms like TCS. So every which way you look at it, the current situation, both in terms of the structural uptrend in IT sophistication and the near-term recessionary clouds in the Western world, both of them are pretty positive. And the result of that is the order book, the punchy order book numbers that the Indian IT services firms are reporting. TCS and Accenture, given that they're the best in class for the West and for India, are obviously at the forefront of that.
In the recent decline, though, Saurabh, have you been tempted widening your IT portfolio, go down the rank to maybe some of the mid-cap IT names too?
So that's a temptation we resist. The reason we resist that temptation is what happens in mid-cap IT, every couple of years, there'll be a flavor of the seasoned stock who's strong at something specific, right? So for example, it could be strong at, say, digital, right? And then when when TCS spots that specific area is flavor of the season, TCS moves in with such might and such strength that within 2 years, they pull away the growth prospects for that mid-cap IT stock, plus the fashion shifts, right? So I've seen remote infrastructure management was once the flavor of the season, then digital, then cloud. With a firm like TCS, what you have the confidence is, regardless of what works in IT, TCS is such a massive gorilla, they're able to muscle into whatever is looking attractive. So therefore, rather than my sitting and trying to guess what is the next trend in IT and buying the mid-cap IT stock, we in Marcellus try to bet on the leader both in terms of order book wins and in terms of recruitment and talent management. We bet on the leader, stay invested in the leader. I think it's now been nearly 3.5 years they've been sitting on TCS.
What are the new additions and what are the subtractions you've done in this market rally? Because on an average, the gains in large cap stocks are 15%, mid cap is 20%, small cap is 25%.
Yes, I think you're broadly right. So this fiscal, our large cap portfolios are up, I think 17, 18%. Our mid cap portfolios are up 15, 16%. Main addition we made is around 3 months ago, we bought Metropolis Healthcare in our small cap portfolio. We believe that the whole funding boom, the private equity and venture capital pumped in money into startup lab companies, that I think is behind us. And Dr. Lal and Metropolis therefore should be well placed to benefit from the hike in prices again in the path lab sector. Barring that, we haven't made any massive investments. We're contemplating a couple more changes to two of our larger portfolios, but we haven't made any massive changes. Our portfolio churn is very low, 10 to 15%. We stay invested in companies for 8-9 years, and therefore, we only hear from new idea from us every, say, 5-6 months.
Right, let's move on. And, the word from the House of Temasek is that they could very well invest $9 to $10 billion in India over the next 3 years if they find the right opportunities. That's the exclusive word from none other than Ravi Lamba. He also talks about the sectors that he's bullish on. Hear out his exclusive chat with Avanne.
We've been investing about $1 billion a year until last year, 2021. In 2022, we saw the opportunity set rising. We could put more capital to work, so we kind of doubled that run rate. We're now looking potentially at doing more than that if we can find the right opportunity. So it's a big if. But if we can, we could invest $9 to $10 billion over the next 3 years in India. That's kind of how we're thinking about the opportunity set. And sectorally, I think we're very focused on the 4 themes that guide us globally. The 4 themes are our future of consumption, longer lifespans, digitization, and sustainable living. So if I think about those 4, and I think about where India is positioned, we find opportunities across the board. For example, in the future of consumption, we have investments in various aspects of the consumption chain. So that could be financial services, technology, healthcare, pharmaceuticals, etc. In sustainable living, we recently made increase our investment in Manipal Healthcare, which is a healthcare services business, because we see a big opportunity there in that space. Similarly, in sustainable living, we've been putting capital to work in some of the areas around ESG focused sectors like energy, green energy. We can talk about that if you like. And then on digitization, the digitization story in India has been phenomenal. There have been some great outcomes from UPI as an interface. We've seen ONDC as another platform that's rising, and these all they're firsts in the world. We don't see them elsewhere, and we see opportunities coming out of that. So a lot of our tech businesses that we've invested in are benefiting from that, and we see that as a trend to continue.
So in specific for the Manipal deal, it was the largest ever by a private equity player in the Indian healthcare space. What is the game plan now for Manipal hospitals after the deal, and what is the strategy for the healthcare space as a whole? Where else are you sensing opportunity?
Yeah, I think we were already invested in Manipal. So it was a portfolio company for almost 5-6 years. We had an 18% stake. And if I zoom out, I think healthcare services is an underserved opportunity in India. The demand is very significant. Clinical excellence and good clinical outcomes can be improved. And access to healthcare services can be provided, not just in the tier 1, even in tier 2, tier 3 cities. So we see this as a long-term a very long-term roadmap. The runway is very long. Manipal is a investment we knew well, so we increased our stake, and we own 59% of the company, and we'll continue to grow that portfolio organically and inorganically as we see opportunities to come.
For the likes of Zomato, Pine Labs, Ola, etc., these investments have played out as the sector as well has matured. Do you continue to remain long-term believers in this entire space?
Short answer is yes. Again, because e-commerce as an opportunity is growing, consumption patterns have become digitized. The digital India stack is actually very interesting, and all these companies will benefit from it. And penetration is growing. The savings rate in India is growing, and therefore the conversion of that savings rate into consumption is going to grow. So we are long-term investors. We focus on returns over the long term, and we think these businesses will continue to compound over the long term.
And given that this focus on technology has been strong now with the adoption of AI, digitalization, as you were alluding to, the internet space, do you think that companies that are very closely linked to this or that are leveraging this technology are likely to stand out and be areas of focus for Temasek too?
Yes, again, the short answer is yes, Avanne, because I think what's happening is, I mean, AI is a separate topic from just digitization. Digitization as a theme, I think, is very intact. Obviously, the other side of digitization is cybersecurity, so we have to be always very careful about cybersecurity risk as any company or any economy digitizes. But we see the opportunity significantly prevalent in India because it's causing a lot of efficiency, creating efficiency in the business models. It's democratizing the whole, access to services, and it's enabling new age businesses to come on stream which could not have done before. So, as the economy grows, this opportunity rises. I think AI as generative AI or AI as a tool, as a development, I think is very different, and we will see that development and that change is happening and being measured now in days, not in weeks and months. So that's something we're tracking very closely as well.
And since you spoke of consumption as well, is there no worry about rural growth slowing down or inflationary concerns heightening being major dampeners or roadblocks for the sector?
Clearly, there is a slowdown right now, but as I said before, we are very long-term focused. We don't have a fund life. We tend to look at businesses over the long term and create value over the long term. So we're not so faced by, by year-to-year volatility in any of these metrics. But yes, I think the fact the slowdown has happened, it's had a bit of a reset on some valuations and a reset on some business models. So we have to go back to our intrinsic value test and evaluate whether this business should be invested in right now and how we should look at a particular sector. So that is a continuous phase, and we have to be careful about those outcomes.
And given that there is exposure to a lot of frontline banking names, Axis, HDFC Bank, etc., do you think that India, when it comes to the banking sector, has been far more resilient as compared to what we've seen overseas with respect to the impact of the financial contagion not having really percolated its way to India?
I think India stands out in some ways, and I'll maybe explain that a bit more. The banks here are in a very good financial position. NPAs are low. Capital adequacy is actually quite high. CASA deposits are increasing. And I think that corporate loans are increasing. Overall leverage in the economy, corporate leverage is 0.6 times debt to equity, which provides a lot more room for corporates to lever up if they have to. At the same time, the regulator has been very forward-looking when it comes to monetary policy. So we think the banks are in a good position, and banks are a great proxy to economic growth, as we've seen elsewhere as well. And if you think about the Indian economy, probably $3.5 trillion right now. You say by 2030 gets to, maybe doubles from where it is right now. The banks will be a recipient of that economic growth. So yes, we are invested in the banks. It's a large part of our financial services exposure and our strategy in India.
Temasek has invested in promoter-led companies as well, the likes of GMR, Adani. What has that experience been like?
I think it's not fair for me to comment on any of our particular investment companies, but broadly we've had a good outcome in many of our investments, and we tend from time to time to see investments needing more attention, some needing less. So I think we have nothing specific to comment on these companies as such. But broadly, all of them play to the theme that we liked. Our portfolio has been growing in India. We're now at 17 billion. It was south of 7 billion 5 years ago. Our overall exposure has grown. We've been a net investor in India, and if I mark to market our 17 billion, it's about 21 billion US dollars in India. So I think there are always cases where you see some uncertainty, some weaknesses in the portfolio, but broadly investment performance has been quite solid.
And you did speak about ESG as well. That's been an important part of the investment framework. Can you tell us more about that?
Sure. I think sustainability is at the core of what we do now. We are facing adverse climate conditions in the world. So we are now looking very carefully at every investment we make. We look at a sustainability track record for it. We apply an internal charge on a carbon equivalent emission of $50 per ton, and we will raise that to $100 by 2030. So we're very serious about our compensation framework. Is very closely tied to our outcome on sustainability. Whether it comes to the energy the social, the environment, the social, or the governance, all of these are very important to us. So if we find an opportunity, which does not meet these, we will just not make that investment. At the same time, we welcome working with companies to improve their ESG track record as well. So we might make an investment to help them improve, and that creates a better outcome, not just for us, but for the planet as a whole. So it's a very important part of our strategy now.
Every market expert is alluding to the fact that there's a manufacturing renaissance playing out in India, and you were as well talking about infrastructure, etc. Would you be looking at this area as a strong theme?
We do think the PLI scheme by the government, the Make in India, is obviously it's all at an early stage, but we see a long runway for this too. So as we find opportunity, we will look at it. We're open to it.
What about agri as an area of investment? Do you think that some of the issues when it comes to fragile supply chains, etc., are now behind us?
No, I think the agri space is very interesting. I think the fragmentation is clearly there, and therefore the opportunity is there to try and consolidate that fragmentation, provide solutions, whether it's credit, whether it's financial, whether it's putting them on a platform where they can benefit, the farmers can benefit, etc. So all of that, I think, creates an opportunity, but it's not an easy opportunity to crack because the fragmentation is still quite wide. And weather patterns are playing all kinds of havoc across the globe when it comes to agri. So we continue to be invested. We invested in Country Delight. We've invested in a few other companies where we will keep trying to increase our exposure. Rivulis is another company we invested in, which has a business in India, which we bought. It's a micro irrigation company. So this is a space that we see long-term potential, but we have to be cautious because there are risks.
Just a quick check-in on what the markets are up to. Holding out around the 19,744 mark. It's quietened out for the small cap index in particular, down about 0.7%. Names like Amara Raja, Spandana, Z Entertainment, Tata Elxsi, Bank of Maharashtra, Shilpa Medicare, those are the casualties in trade, while Sheela Foam is having a terrific run on the news. Mahindra Logistics as well as Schneider Electric and Havells up a solid 4% in trade. All right, another corporate voice joining in on the show right now, and we have Mr. B. Ramesh Babu. He's the MD and CEO at Karur Vysya Bank, here to talk a little bit more about the term extension as well as the outlook on the financials. Thanks so much for taking time out. Congratulations on the appointment, but I wanted to get started off by talking a little bit about Karur Vysya Bank's financials, in particular the margins, because across the banking system, we've seen a contraction. What is it that you're looking at when it comes to margins for Karur Vysya?
First of all, good morning and thank you. This is a wonderful quarter if you look at this quarter, because both on the business front as well as the profitability, we did very well. If you look at our profit, 2 years back in 2021, the whole year profit was 359 crore. Whereas if you look at this first quarter, the quarter profit is 359 crore. So this has come on account of many levers which we have worked. It is on account of the business growth. Comfortably we are growing, which used to be in single digit. Now it has moved to double digit, and every vertical is contributing further. Asset quality, most benign quality. In fact, the SMA is 30 plus is below 1%, and the net NPA is at 0.59%. Gross NPA is below 2. All these things are allowing us to have a good profitability. If you look at our NIMs also, it is 4.19. So we guided in the month of May for the March quarter results when we were talking. So we said that both the quarters 1 and 2, we will be above 4. So it actually aided by two things. Though our cost of deposits has gone up by 35 basis points, the yield also supported by 14 basis points. One of the advantages the bank has is 47% of our advances portfolio is still MCR linked. Agreed? Last year it was 57, it has come down by 10%, but still we have some more room left over for the MCLR repricing. So that way we feel next quarter also we will be able to maintain the same trend.
Okay. Let's understand the impact of high interest rates. In the first leg of an high interest rate environment, banks, they have higher NIMs. But now that interest rates are peaking out, do you think your NIMs will come under pressure?
Absolutely, because you see last 3-4 quarters, if you see, it has come down, and we also estimated the same way. If you look at our this quarter, it has come down by 35 basis points over the March. Not in the sense that, not the NIMs. Cost of deposits has gone up. So NIM has come down by 10 basis points, but still it will come down. but still we'll be able to maintain above 4% for the next quarter because it's a two-pronged approach we are doing. We are gauging the inflow of the deposits. Wherever the flow is good, actually in few of the cases, we have reduced the rate of interest also for the few buckets. So that is reducing our cost of deposits. And we have invested some heavily on the feet on street for the CASA acquisition and the retail sales. So this is going to help us in the days to come. So that will further reduce the cost of deposits. Other side on the yield, what we are doing, the low yielding advances whichever are there, we are trying to get out of that. We are engaging with them. If they can improve the yields, well and good. Otherwise, the risk reward ratio is not matching. We are willing to get out a few of them. That is the reason you could find that the corporate growth is only 2% this quarter. Ideally, had we compromised on the yields, it would have gone to 15%. That is not an issue. So that way, it is a multi-pronged approach we have been taking, both on the yield fronts as well as the cost. So to protect our NIM, but whatever it is, next quarter we will be able to have a clarity on third and fourth quarter where we will be.
Your deposit growth. Do you think that you can sustain the sequential deposit growth that you have been clocking in so far?
No, this quarter it's a quarter on quarter is 5% is, but whatever it is overall we have planned for a 14% growth because advances we are planning to grow at 14, more or less at the same rate if you are able to grow. So we'll be able to maintain here and there the CD ratio and we'll be able to maintain, not an issue. So as against that 14% what we have planned. So on an annualized basis, if you look at this 5%, it comes to around 20%. Even if in subsequent quarters if it comes down also, it will not matter much to meet our advances growth, what all is required. So we'll carefully gauge and we look at it. Wherever the requirement is not there, we may have to reduce the deposit rates. So that may involve some sort of a reduction in the flow, but overall the bottom line will be improving. So that way, in a calibrated way, we'll go for that. So though we will not aim for 20% of the deposit, we will look at what is needed and all. If you are able to make money out of the deposit, what we are getting it, we will definitely go for that.
Right. On the loan growth side as well, I wanted to understand because Q1 has been very strong in a seasonally weak quarter for you. What trends are you seeing and what is your full year target and guidance then, now that you have a strong quarter at the back?
I agree with you. So we estimated around 14%. So because that has to come. Now, what amount of corporate loans still we'll get out of that, I am not clear yet because we are engaging with few of the big corporates where the yields are pretty low. If they are not going to yield for the yields, so naturally we may have to get out of that. So that way I think overall between 14 and 16 in this range we may be able to grow. So one thing we want to understand, so aggressive growth at this stage when you are relatively comfortable, so will make you jittery. So our intention is the growth has to be safe and the asset quality should not be there. Both should result in a proper profitability. So we will look at a point, if we can reach a decent point where we can take to the next level, so we will take it from there. From now onwards, at least we'll think that to maintain the existing setup and all, and 14 to 16% we will grow, and later we will take a call on that for the next phase.
Right. Is there a specific loan mix that you're targeting as well for the bank?
Yeah, absolutely. If you look at it, ours is a majority is a SME focused bank. So last 3-4 years, if you look at it, our 33% of the portfolio is from the commercial. So which we call SME's majority goes to the commercial. So next is around 22% we maintain in retail. So that can go up to 25. So earlier we were maintaining around 30-35% for the corporate, which has come down drastically now to 21%. So that has been taken over by the agriculture. Agriculture has gone up. So why we felt agriculture is one of the good areas is the area of operation where we are working, there's a lot of scope for agriculture. And above all, this is a majority is a gold belt. So people are inclined to pledge their gold. So that way, a lot of growth comes in the gold loans, which is relatively safer on one front. There is no capital cost for this. And above all, so it accounts for the agriculture for the priority sector. With all these things, we focused on the gold. But whatever it is, if you can look at our presentation, so last 3 years, more or less, our gold loan is at 25% of the overall portfolio. That's why we don't want any concentration risk in any other product as well as the portfolio. If you look at it overall that way, around 80% of the portfolio is RAM. retail, agriculture, and MSME, and 20% is around corporate. So we will try to contain these levels more or less, and focus will be on these three segments because the yields are relatively better here compared to corporate.
Sure. Your credit costs also have fallen. PCR seems to have risen. You seem very well covered. Where do you then see risks or concerns at all for your book currently?
No, it is not the question of risks and concerns. You see, this year we made a provision of 25 crores floating provision also, because what we felt is when the good times are there, so you need to think of a probable bad time which may come up. Otherwise, if you think today everything is rosy and all and hunky dory, it will continue like this. So we may be at fault because the impending catastrophe we may not be knowing, but there may be catastrophes in the future. So that is the reason what we thought continuously we have been uh, improving our PCR and the floating rate. These sort of things we are doing so that any eventuality tomorrow comes up, so we will be able to absorb the shock without any hassle, because we have come after a great journey to this stage now, and now more or less every parameter what you can conceive, so we are able to tick the boxes and all. So from now onwards, the challenge is how we are going to sustain. I know very well it's a stimulating challenge, but whatever it is an important for us to see that what all we have gained, we should not lose.
All right. And what part of your book is secured? Can you give us a sense? Because even your cost to income ratio has gone up. What has caused this increase? And where can we see that shaping up in the near term?
Yeah, there are two questions regarding the secured book. If you look at it, our unsecured, which people call usually for a personal loans and credit cards, all these things is around 1.85%, which is below 2%. So though we have made a small entry into MFI segment with a very good established partner to take it forward, because we will not have the wherewithal to directly handle these sort of things. With an established partner, we started few months back, and we could get a portfolio of around 55 crores in that now. And likewise, the personal loan front also, we have a very good arrangement with Amazon BNPL. So where we have lakhs of customers with our partner. So the partners, what we have, the customers whom we have acquired for the last 3-4 years, we are mulling on that through analytics. We are trying to get out who are good. So whether we can extend these unsecured loans to them, that is in an advanced stage. Once we get that, we may go up to 5% for the unsecured book to start with. Coming to the cost to income ratio, if you can look at our past, it used to be 50%. Many quarters, it used to be above 50%. So we have brought it down, and last quarter was 42, and this quarter is 47. There are a variety of reasons for this. This year, what we did, the ex gratia, what we pay annually, last year it was in the second quarter. This we made it in the first quarter this year. So in addition to that, as I was mentioning, we have invested a lot on the retail liability sales. We have acquired the people, around 905 people we have taken from the market from different banks who are absolutely oriented towards the sales. So this will go up to 1300. So we have different verticals under that. It can be corporate, trade, retail, salary package, all these. We have started that. It is in a formative stage now. Once these people they come up, I agree initially we are making an investment. This will help us in different ways. First thing on acquiring a low cost deposit, and second thing is to cross sell, and third thing is to get asset leads from these teams. So that is the reason what we thought, when the things are good, you need to invest something on the future. Otherwise, future will be bleak. So whatever it is, we have guided that our cost to income ratio will be around between 45 and 50. So we are at the midpoint. So we will be doing it. But every rupee what we are spending now is for the future, and it's an investment, not an expense.
I wanted to talk about, your deposit costs as you focus more on deposit growth, because your deposit cost has been lower as compared to your peers. Do you believe that this is going to perhaps move closer to what your peers have been clocking as an average?
No, abruptly it may not move because our rates are still more or less competitive. So we know it, the savings bank interest rates also. So we have not changed it because we found from a back of an envelope calculation that, so even if we change the rate of interest on savings bank, it is not elastic actually. The inflow is not matching with the cost we are going to incur. So there is another downside for that is, if we increase the savings bank interest rate, the existing portfolio gets repriced rate. So the cost will have to pay across the board immediately, whereas the benefit may not be there. So that is one area which is helping us. And second thing is, so the cost of deposits, we will see the market and what bare minimum we'll require, we'll keep it. If you look at our portfolio also, 80% of the portfolio is retail. That is households. Majority of them are households, self-employed. Such a granular portfolio we have. So these people are not agnostic to the rate of interest. The relationship what we maintain with them, that matters a lot. The great thing about the organization is the culture. The organization culture, the way they maintain the relationship with the customers. Many people for the generations they are dealing with the bank. That is helping us even in the deposit accretion also by paying a more or less a decent rate of ratio interest rate and still able to get the deposits.
Good to have you on board. Thanks so much for joining in and giving us those latest details. That's the management speaking to
Thank you
ET
very
now, talking about how they are looking at around 80% of their overall portfolio RAM, and they are looking to grow in the band of about 14 to 16% as of now. A 14% growth on deposit is what is expected. Okay, right back to the markets then, and just want to identify what the frontliners are up to, because do remember, since yesterday we have seen that participation from some of the large cap stocks. Whether or not that's continuing into today's trading session needs to be monitored. Yes, HDFC Bank is continuing to hold out around the 1690 mark. You've got Reliance Industries up about 0.5% or so, and banks are doing a lot of the heavy lifting, the likes of Axis Bank, ICICI Bank, and then of course tracking what an IndusInd Bank is up to, because do remember it will be coming out with its numbers later today and the street will closely be eyeing this stock. L&T, Maruti Suzuki as well is giving it company, and on the flip side you've got Titan, which is down about 1.5% or so. Ultratech Cement is in the red. Tech Mahindra, M&M, TCS along with ITC, those are some of the stocks that are taking a bit of a back seat. But speaking of then IndusInd Bank, I think we can take it across to my colleague Harsh, who's joining in to give us a sense as to what the ET Now poll is suggesting. We are expecting an uptick in NII as well as PAT. Let's take it across to Harsh, who joins in with the ET Now poll. Harsh?
Well, let's look at the NII for IndusInd Bank, expected to go up by 18% year on year, largely aided, the NIMs will largely be aided by the fixed book. That will aid NIMs. NIMs should continue to sustain over the 4.2% mark for IndusInd Bank in this quarter. Of course, wait and watch for that final number. Let's also look at operating profit, expected to go up by roughly 12% year on year. Around that 3850 crore mark is where the operating profit is expected. Provisioning expected at roughly 1000 crore versus the 1030 crores number in Q4 of FY23. So no surprises expected on the provisioning front. Let's look at PAT. PAT expected up 29% year on year, expected to go up to 2100 crore, that profit after tax number. In terms of the balance sheet itself, we've already seen that growth is good on both sides. You've seen 21% growth on the advances side, 15% growth on the deposit side, and in terms of asset quality, we are expecting to see largely good resilience coming through, stable asset quality expected. In terms of what to look out for, the MFI book is going to hold the key. Any change there, any movement, what kind of growth are we seeing on the MFI book is going to be key. Also, what kind of credit costs are we going to see, because the street is expecting credit costs to start to come off, but of course need to wait and watch as to where the credit cost number is as well.
Well, tomorrow, that's July 19th, is the last day to buy Reliance Industries to get the demerged share of Jio Financial Services. For every one share of RIL, remember, the shareholders are going to get one share of Jio Financial. Somit is here with more details on what exactly can a shareholder do. Somit?
Well, given that the demerger date for Reliance Industries and Jio Financial is July 20th, the last date for any shareholder to buy the shares of Reliance Industries to participate in this demerger would be July 19. Now, the ratio for this demerger is 1:1, which means that for every
one share of Reliance Industries, the shareholders will get a new additional share of Jio Financial. Now, the listing date for Jio Financial is still not known. Now, what we know about Jio Financial is that the chairman and the CEO of this company are both ex-ICICI Bank leaders. It's KV Kamath, who will be the chairman of Jio Financial, and Hitesh Sethia, who will be the CEO of Jio Financial. Now, what will Jio Financial do? It will provide lending services to consumers, merchants, and it will expand in other verticals as well, like insurance, broking, payments, and asset management. Now, it aims to build a large digital fintech platform for all Indians, and going ahead, they're also open to bring in strategic and financial partners in the company. Now, when it comes to the valuation part, Jio Financial will be owning around 6.1% stake in Reliance Industries, which is treasury shares, and the value of this treasury shares stand at close to 1.1 lakh crore. Apart from this, the company would have a net worth of close to 28,000 crore rupees. So based on these numbers, what we understand is the company's book value would be close to 200 rupees per share, and brokerages have assigned a value of around 168 to 190 rupees per share when it comes to Jio Financial. On the listed side, Jio Financial will be competing with Bajaj Finance, Paytm, PB Fintech, Angel Broking, IIFL Securities, and Paytm, as I just mentioned. And on listing, what we understand is that Jio Financial's market capitalization would be close to 1.4 lakh crore rupees, which means that the company would be the fourth largest financial institution listed in the Indian stock market. Now, how could Jio Financial benefit? Now, it is most likely to have a AAA rating similar to its parent company, that is Reliance Industries, and this AAA rating will help the company get the cost of funds on the lower side. Now, only 6 large NBFCs in India have a AAA rating, and Jio Financial would be one of them. Apart from this, given the fact that Reliance Industries retail arm has a very large distribution base, the company will benefit from that also, because Reliance Retail has more than 18,000 stores in India and nearly 78 crore footfall on an annual basis. Apart from this, the telecom business is also the largest in India of Reliance Industries, with around 43 crore telecom user base. Now, what would be the impact of this demerger on the indices and the FNO? Now, the FNO contracts of Reliance Industries would expire on July 19th. On Nifty and Sensex, if you see, Jio Financial would be a part of the index at a constant price. And how will this constant price be discovered? Well, the opening price of Reliance Industries on July 20th minus the closing price of Reliance Industries on July 19th, the difference amount will be the constant price. On MSCI, it would be a part of the standard index, and on FTSE, it would be a part of the index if the listing is happening 20 days post the demerger.
Much, Samit, for breaking it down for us, giving us all the details on the Jio Financial demerger. But the other stocks that we're tracking are LTI Mindtree and Tata Elxsi, largely on the back of their numbers, both of which were a bit of a miss. Let's take it across to Anisha, who tracks those companies and joins in with a synopsis. Anisha?
Hi, let me start with Tata Elxsi first, because that stock is down in the trading session. It was the 5th consecutive quarter that the growth rate has been coming down for the company. Remember, last year, this time around, the growth rate was over 6% on a sequential basis. This time, the growth was just around 1.2%, and that's the key disappointment. The transportation vertical, which is the mainstay of the company, has been on the back foot. So that continues to be one of the pressure areas for the company going forward as well, though they are expecting that transportation will bounce back. But for now, that's the weakness that we're talking about. The margins came in slightly better than expectation as far as Tata Elxsi is concerned. They dipped by only 20 basis points, and this is despite bulk of the wage hike impact coming in this quarter itself. Remember, Tata Elxsi takes the hikes in 2 parts. So for junior employees, it's been taken in Q1. For senior management, it will happen in Q2. So going forward as well, there's that overhang that margins might stay a bit under pressure. The deal wins were quite strong, so nothing much to complain there. But we are expecting that there is going to be a slowdown going forward. At least that is what the analysts are penciling in. And given the fact that stock trades at very expensive valuation of...
Let's cut across then to the Adani Group Chairman, Gautam Adani, addressing the
enterprises, then known as the Adani Exports, launch its IPO. I just turned 32. Today, as I reflect over the past years, I'm grateful to so many who have enabled your company to come this far. While our true ambitions still lie ahead of us, when we make time to look back, we also realize how much ground we have covered over the past 30 years. Along this journey, if there is one characteristic that has continued to define us, it has been our resilience. The resilience that allow us to get up stronger every time we take a hit. The resilience that drives our belief in the nation we call our Matrubhumi. And the resilience that gives us the passion to follow our dreams. And I will touch upon each of these today. As all of you are aware, on the eve of Republic Day this year, a US-based short seller published a report to short our stocks. Just as we are planning to launch the largest follow-on public offering in India's history. The report was a combination of a targeted misinformation and discredited allegations, the majority of them dating from 2004 to 2015. They were all settled by appropriate authorities at that time. This report was a deliberate and a malicious attempt aimed at damaging our reputations and generating profits through a short-term drive down on our stock prices. Subsequently, despite a fully subscribed FPO, we decided to withdraw and return the money to our investors to protect their interest. While we promptly issue a comprehensive rebuttal, various vested interests try to exploit the claims made by the short seller. These entities encouraged and promoted a false narratives across various news and social media platforms. Consequently, the Honorable Supreme Court of India constituted an expert committee to look into this matter. The committee included individuals known for their independence and integrity. The report of the expert committee was made public in May 2023. The expert committee did not find any regulatory failure. The committee's report not only observed that the mitigating measures undertaken by your company helped rebuild confidence, but also cited that there were credible charges of targeted destabilization of the Indian markets. It also confirmed the quality of our group's disclosures and found no instance of any breach. While SEBI is still to submit its report, we remain confident of our governance and disclosure standards. It is my commitment that we will continue to strive to keep improving this every single day. Our track records speaks for itself, and I am grateful for the support our stakeholders has shown as we went through these challenges. It is worth noting that even during this crisis, not only did we raise several billions from international investors, but also that no credit agencies in India or abroad cut any of our ratings. This is the strongest validation of the belief that the investors have in your company's governance and capital allocation practices. Over the past decade, one statement that I have repeated dozens of times is my belief in the future of the nation we call our Matrubhumi. Let me try and set some context. Today, there can be no denying that the world is continuing to be hit by multiple shocks, be it the climate emergency, geopolitical challenges, supply chain and energy volatility, or a persistent inflation. We have never had a time when such events were happening simultaneously without a clear solution in sight. Add to these opportunities and challenges because of the technological revolutions, especially the breathtaking advances in artificial intelligence, and what we have is a massive potential reset in the existing global operating models, the future of work, the future of learning, the future of medicine, and in some ways, the future of economic growth itself will need to be reset. Therefore, as we end one financial year and begin another, it is important to take a step back and assess the global situation and India's position as part of this landscape. While economic cycles are getting increasingly hard to forecast, there is a little doubt that India, already world's fifth largest economy, will become the world's third largest economy well before 2030, and thereafter the world's second largest economy by 2050. It is well understood that for any economy to implement policy and lay the foundation of growth, a stable government is critical. And we have seen this impact with the implementation of several structural reforms that are critical for a strong, sustainable, and a balanced growth. This stability, coupled with India's demographics and a continued expansion of internal demand is a potent combination. Our nation's demographic dividend is expected to drive consumptions and accelerate the growth of a tax-paying society at a record pace. The United Nations Population Fund projects that India's median age will be just 38 years even in 2050. Over this period, India's population is expected to grow by approximately 15% to 1.6 billion, but the per capita income will accelerate by over 700% to about 16,000 US dollars. On a purchasing power parity basis, this per capita metric will be 3 to 4 times higher. And we have the statistics to prove it. Following our independence, it took us 58 years to get to our first $1 trillion of GDP, 12 years to get the next trillion, and just 5 years for the third trillion. I anticipate that within the next decade, India will start adding $1 trillion to its GDP every 18 months. This puts us on track to be a $25 to $30 trillion economy by 2050 and will drive India's stock market capitalization to over $40 trillion, approximately a 10x expansion from the current levels. I would urge you to reflect on these incredible possibilities. India's success story of a balancing economic growth and a vibrant democratic society has no parallel. My belief in the growth story of our Matrubhumi has never been stronger. And now let me talk about our results. Our FY 22-23 operational and financial results are as much a testimony to our success as testimony to the continued expansion of our customer base, be it on the B2B side or the B2C side. Our balance sheet, our assets, our operating cash flows continue to get stronger and are now healthier than ever before. The pace at which we have made the acquisitions and turned them around is unmatched across the national landscape and has fueled a significant part of our expansion. Our national and international partnerships are a proof of our governance standards. The scale of our international expansion is validated by our success in Australia, Israel, Bangladesh, and Sri Lanka. Some of our key achievements are as follows. The Adani Group of companies set a new financial performance records for FY 22-23. Total EBITDA grew by 36% to rupees 57,219 crores. Total income grew by 85% to rupees 262,499 crores, and total PAT grew by 82% to rupees 23,509 crore. The group's accelerating cash flow further improved our net debt to run rate EBITDA ratio from 3.2x to 2.8x. Our flagship company, Adani Enterprises, continue to successfully demonstrate its incubation capabilities with our new businesses accounting for a massive 50% of its EBITDA in FY 23. Of the several projects underway, two of the key ones include the Navi Mumbai Airport and the copper smelter. Both are on schedule. The Navi Mumbai Airport is preparing for operational readiness and airport transition by the December 2024. The integrated resource management volume increased by 37% to 88 million metric tons versus 64 million metric tons in FY 21-22. NDTV is expanding its international programming and coverage to serve a vast range of audiences across the globe.
That is Gautam Adani, chairman of the Adani Group, speaking at the AGM. A lot of announcements as well coming about, talking about the short seller reports as well as outlook on the government and how it's critical for the economy to flourish, and giving some more projections and targets for the company as a whole. That's the entire cluster of key projects that are on Adani Group stocks as well that are in the spot in focus. And